PayPal is just getting destroyed lately. I mean, it's basically making a new 52-week low every single week, and it seems like there's no end in sight. And now we have some on Wall Street calling for the end of PayPal stock as a growth company, which means an even bigger problem for our PayPal shares. So let's kind of work through this Wall Street narrative and kind of separate fact from fiction with all of it. So make sure you like the video if you like getting insight on exactly how to interpret what Wall Street's saying and exactly how to take it. All right, so this video talks about a lot of actually great talking points, both negative and positive for the stock itself. So let's deep dive into it and I'll break it all down for you guys. And on top of that, I'll let you know if I think PayPal is basically not a growth stock anymore and much more of a value stock, and kind of what all that means for the stock in general and for our shares.
Now let's bring in George Tillis, a senior markets correspondent here. We're talking PayPal, George. This one has been suffering, as I mentioned before we left to break. This thing's hitting 6-year lows. I mean, it doesn't seem like there's any reprieve for this name.
No, not at least in the near term. I don't think so. I mean, if you look at the stock, it's down about 43% over the last 5 years, and it's been drifting lower since its peak back in 2021, which is over $300. And it's been unfortunate for PayPal investors, but I can see what's going on with it. I'll explain in a second. But you got to.
Yep. I mean, just right there, right off the bat, obviously the folks that were buying at 300, just like many stocks back then, they were just significantly overvalued. I could never justify, an over $300 valuation for that stock, but that's part of investing. This is still kind of a hangover that's looming from that time frame there, specifically for PayPal. Obviously, the hangovers for a lot of stocks after that time frame, but specifically PayPal's hangover is still going on. So obviously that tells you something about where that valuation got in the first place.
What they do, they're the largest electronic payments provider globally. Some estimates have 40% market share for PayPal, but from business to consumer standpoint, they're essentially the number one leader in payment solutions. But they also have consumer to consumer payments through Venmo, international transfers. They've got their division called Zoom, but also e-commerce solutions, which includes things like mobile web payments for payment processing and even invoice management through their Braintree division. So the company's.
I really like the way he's pointing out all the different avenues there for PayPal to actually be making money. I'm always surprised how many people say, I don't like PayPal for one reason or another, but I'm going to, because Venmo is going to eat there. And it's just kind of like, well, Venmo is actually part of PayPal. I don't think a lot of people understand it. Same thing with Braintree and a lot of the things kind of going on behind the scenes with Braintree. I don't think a lot of people understand. That's basically like AWS with Amazon. Think about that product, 2 years ago in regards to where it is kind of in its growth engine in regards to what it can provide long-term to PayPal there as it continues to grow. Again, it's growing like crazy, but obviously, as we've seen, it's not going crazy enough to really affect the bottom line yet. And that was the same thing with AWS a few years ago. Everybody was saying the same exact thing. What the heck is Amazon doing? That's not going to do anything for the help the bottom line. Don't worry about it. And now it's an absolute beast, generating huge numbers to the bottom line there for Amazon. So that right there is kind of what Braintree is. But anyways, that right there was just kind of a quick, good overview. How many of those did you know PayPal was invested in and using and deriving revenue from in the first place? A lot of folks didn't know all of those pieces all the way together. So great job there pointing that out.
A lot of acquisitions in the past few years, and some would say that hasn't manifested into good profitability profile for the business. And I can see that if you even compare the sales for PayPal compared to 2018, their sales are higher to 28 billion versus about 15 billion in 2018, which is nearly double. But if you look at the share price, it hasn't really reflected that. So I think what we're seeing here is just a classic case of, the sales have been growing, but the sales growth has been decelerating. And if you look at the earnings growth for PayPal, the estimates for earnings are only about.
That right there is an excellent point he just made too, in regards to basically you're getting PayPal, twice the size company for the 2018 price, or I mean, it may even be below the 2018 price now. I don't know. Should have put a chart before I looked there. But anyways, the point being, it shows you how much more growth has happened, how much better, how much stronger financially the company is. Obviously, I bet if you looked at free cash flow and a lot of other things like that as well from 2018 to now, you've seen huge growth in all those. And yet you're paying the same exact price today or less than you were paying back in 2018. And that right there is a huge distinguisher. However, he's getting ready to make a point here about some of the negatives of PayPal And this right here is kind of, we can't just take the bullish argument, right? That's how we end up paying crazy prices, $300 for PayPal or $400 for Tesla or whatever the case was. And, you end up not necessarily acknowledging the bad things that are going on there that kind of should give you some pause and some things you need to look at.
Percent, whereas sales about 8%. But if you go back to their 5-year average for earnings growth, it was in the mid-teens, around 16%. So even though sales have been growing, and even though sales growth is about half of where it was, let's say about 5 years ago, earnings growth is only 1/4 of where it was 5 years ago. So what I see here is a company that from a financial standpoint is not cheap from a value standpoint, nor is it a growth stock anymore. So I think this is one of the reasons why, or just a couple of reasons why, it's fallen out of favor by investors.
Yeah, I don't 100% agree with this point, but I can't say in regards to trying to figure out, which style investor is going to come in and scoop this up. For me, I definitely think it is still long-term a growth stock. However, they need to get back up over 10% growth, basically double-digit growth. You can occasionally dip down and then dip back up into it. But they need to have some quarters where they're hitting that 10% mark consistently, or some years where they're hitting that mark consistently, because that right there will definitely push them back into that growth category and keep them out of that value category that they don't necessarily want to be in right now. And I don't think they should be in right now, given their free cash flow and everything else that's happening with the company.
Around 81% off its highs. This stock now trades at the cheapest price to sales multiple in its history. It's not like it's an outdated or horse and buggy business model. It's digital payments, George. It's Venmo. It's all the things that the digital economy seems to be drifting towards. What's the problem? If George Tillis was the CEO of PayPal, what would he do to turn the stock around?
Well, I mean, I can tell you this. When you look at gross margins for a digital business like this, it's actually very low. And so with that said, I think there's something going on internally they can do to reduce expenses. I think also divestitures in terms of some of the businesses they purchased over the last few years need to go away. They sold off their European buy now, pay later business to KKR. They earned about $1.8 billion. But with the proceeds, they're buying back shares. I mean, I looked at their share count. The share count is down compared to 5 years ago. And ideally speaking, it hasn't supported the stock. And I think what they...
Yeah, so right there, obviously, I love the share buybacks. I think that's a great place to put your free cash flow, especially when you're in a transition period like they're in right now. And with the stock being beaten down so low, you're picking up cheap shares, which of course is exactly what you don't want to be buying shares at $300 per share. You want to be buying them down in the 50s, 60s, 50s, whatever the case is, a lot cheaper. So that way, obviously, it increases our value as shareholders, even if we're not seeing that reflected yet in the share price. At some point in time when the ship is righted, you're going to see that. And to some of his other points about some maybe opportunities they're missing and such, that right there to me is much more about the CEO, the new CEO coming in and what he's going to do. And that's the reason for a lot of the delay and a lot of that.
There's a problem on how to deploy the capital that they're generating. They've got a lot of total payment volume. I mean, it's over $1 trillion in total payment volume globally. I think the challenge is really the economics of the business itself, whether it's divestitures that are needed. I think they need to improve their scalability to capitalize on the fact that they're a very popular and very ubiquitous brand from a digital payments processing standpoint.
All right, great breakdown here of PayPal. 431 million active accounts, and this stock just cannot right the ship here at this point. All right, thanks to George Tillis for breaking that down for us.
All right, so obviously some things I agree with, some things I don't agree with there. In regards to, he's right. There's a lot of things internally that they can do to improve those margins. The problem that PayPal's had for 2 years now is the CEO knew he was leaving. He didn't want to change anything. He didn't want to make a lot of big changes. Didn't want to, obviously, like they were saying, hey, you got some business units that you bought that maybe you need to get rid of. Those acquisitions, they don't always work, right? Matter of fact, a lot of times they don't work. And they're bringing in a CEO who's very, very good at acquisitions and bringing things in that actually improve the bottom line and not hurt the bottom line. So it stands to reason that maybe he has some expertise in getting in there, analyzing what is hurting, what's not hurting. And man, when you start to cut albatrosses off your business, like an acquisition that was just a bad acquisition and nobody wants to admit that it was a bad acquisition, and you start getting rid of those, all of a sudden that's when you see those profitability numbers really start to pop up. Those EPS numbers really start to pop up once you go through the pain of divesting all of them. That's exactly what you start to see moving forward. And a CEO is on his way out the door, maybe doesn't want to make a mistake, maybe just doesn't want to rock the boat, isn't trying to work through a transition period of time with the stock, isn't going to make calls like that. And he's leaving it up to the new CEO to come in and figure out, hey, what do you want to cut? Where do you see profitability increases? Do you want to come in and, kind of do like what Meta did? So that's, kind of a Meta style turnaround of, hey, come in here, start cutting the fat per se, to include divesting businesses and employees and business units and all kinds of other things like that, and really get it back down to what it does best, what is most profitable. So that way those gross margins improve significantly. And more importantly, you're kind of being able to divert that cash over to things that accelerate the growth of the company again. And we can't say that, obviously, like they pointed out, it is in a growing space. It is in the future of payments and all those other things like that. Oh, by the way, they're also the big dog in the yard in regards to that, which gives them an advantage. So all those things to me are all bullish signs for PayPal long term, and why I wouldn't put them in that value territory. I absolutely think it's still a growth stock. It's just kind of a growth stock that's hit that wall, hit that plateau, and it needs to make some changes and do that with the business. Meta has done it 3 or 4 times now over the course of its lifetime, just in a short lifetime relative to a stock like Apple that's done it multiple times over, 40 plus years. But, this is a much newer company, much like Meta is, and they've hit their peak, not necessarily a peak, they've hit a plateau, and they need to move that forward in regards to the stock. And that's exactly the reason why they're bringing in a new CEO who does have specific acquisition experience in regards to large company acquisitions. And obviously, we'll see what he does in regards to turning it around and all that. But you're not going to see large movements. You're not going to see large investors step in until we kind of work through all the things that need to happen as a new CEO comes in. That's the reason why I'm so excited for the earnings call. I'll do an earnings preview for PayPal before we get there. But that to me is definitely the key driver for so many things. And for me, this earnings call coming up is the biggest earnings call in PayPal's history, in my opinion. Now, we'll wait and see what happens whenever we actually get there. But, kind of just from an outside in perspective and looking at everything that's going on with this stock and all the opportunity and all the pitfalls that are right in front of them, you're kind of like, which road do you pick, right? Do you pick the one that's kind of the road to glory, or are you going to pick the road that's the road to disaster? That right there is kind of what we're facing with these earnings. And that's why I'm so excited for those earnings. So definitely be looking out for that video here. It'll be coming shortly. But in regards to, is PayPal a growth stock to me? Yes, it's still absolutely a growth stock. We have not even approached the point of it being a value territory yet, in my opinion. But I can't say that there aren't legitimate arguments out there for, hey, it is drifting towards that value territory if we're not careful here and we don't right the ship. So can't disagree with that at all. But for me, it's still a growth stock. And remember, if you want to have access to me anytime to ask me questions about PayPal, or you want to take 5 courses for free, learn how to do evaluation, learn how to put price targets out there, you want to see all my buy and sell alerts in real time, see my watch list complete with price targets, you want to be part of the best 6, 7, and 8-figure Discord out there, you want to have access to a stock analyzer tool completely for free that other folks charge you, pretty much the price of my membership just to use their tool, make sure you check out the pinned comment down there and see if a membership's right for you. And click this video here if you want to see exactly what I'm buying in this market, and click here to see my exact plan for this market. So thanks for watching, and we'll see you in the next one.